Jan. Now, let's move to the next session, Green Financing, the new world of opportunities. So here we will be discussing about the exploration of emerging financial mechanism and investment strategies that enable NBFCs and other financial institutions to unlock green finance opportunities across the sectors like clean energy, agri-tech, and sustainable infrastructure. So to build the conversation, may I request Mr. Umesh Revankar, Executive Vice Chairman, Shriram Finance, Shri R. Balaji, MD and CEO, PTC India Financial Services, Shri Labanya Prakash Jena, Sustainable Finance Consultant at IEEFA, Tushar Thakkar, Partner, the Blended Finance Company, and moderator of the discussion is Dhruba Purkayastha, Director CEEW. Just a sec, the prep up is taking a bit of time. During our pre-conference discussions, we all have identified the opportunities that we all have to abide by Prime Minister's commitment that we have to become a carbon neutral by 2070, but many of the efforts need to be streamlined and many of the ideations need to be put in place today so that we achieve the carbon neutrality. Perhaps the internal target should be that we should achieve it much quicker. But I'm sure that many of the ideas identifying newer opportunities would emerge out of the discussion. So we are all set. So with your permission, audience, may I invite Umesh Revankar ji, please come forward. Executive Vice Chairman, Shriram Finance, R. Balaji, MD and CEO, PTC India Financial Services, Labanya Prakash Jena, Sustainable Finance Consultant at IEEFA, Tushar Thakkar, Partner, the Blended Finance Company, Dhruba Purkayastha, Director CEEW. Santanu Agarwal, Deputy MD, Paisalo, had to join, but he had sent a message that he suddenly fell ill and he couldn't join us. We will miss his presence here. Dhruba, mic is yours.
Thank you, Anilesh. Thank you. Thank you for organizing. Thank you, Dalberg, CIEEW, for organizing this event, which is, green banking, green credit. So we start with this session. So just to kind of repeat, Labanya, Tushar, Balaji, and Umesh. So if I've got all of you right, I would use this time as effectively as possible by starting off with saying this is a session on finance and opportunities. Well, given that the country from a policy perspective, from a net zero perspective, from a net zero transition, scaling up renewable energy, EVs, you can see the policy movement over the last 5 years directing itself towards essentially creating opportunities. And just wanted to take 2 minutes and also exercise my privilege as a moderator to kind of mention in this forum that, we just a couple of days ago, we had this Niti Aayog forum which talked about modeling. And modeling where? Modeling, we start with engineering, climate models, then we get into energy assessment models, economic models, general equilibrium, and then there is this input. And finally, it comes to saying, okay, all this is being done, and where's the money going to come from? So there is opportunity, need, and where's the money going to come from? So just to have an open question, and if I can start with you, whichever order, Umesh, you want to go first, Labanya, whoever, is green finance, and what is really the opportunity for NBFC lending, banking for the financial sector in this whole economic transformation, green economic transition, all of it? And what is your sense of this being an opportunity? Thank you. Umesh.
Thank you. See, the way I look at the opportunity, because let me go to the opportunity that's available for financial sector, NBFI or on the banking. When the change comes, people start adopting to the change. That means, imagine 20 years back, when the CNG was made compulsory in the city transportation. In fact, CNG availability itself was limited. In Delhi, I remember, they will say, you go to this CNG station. That means in the entire Delhi, there will be 4 CNG stations. And there will be miles of queue for filling up. So government made it mandatory, but CNG availability was not there. So what happens is the creation of government supporting the change by compulsion becomes important for a change. Otherwise, people don't change. Like now, there is a 10 years rule in Delhi. So I think if the public transportation, if the government says, of course, there is some announcement. I understand that from August 15 that all new permits will be given to only electric vehicle. If that changes comes, then there is a forced change. But there is a financing opportunity when there is a change. Because all the new assets have to be electric vehicle, then automatically the economics of operation will change as per the cost of acquisition of the asset. What we call it as a TCO. So cost of acquisition and how the economics will work out. And ultimately, either consumer will pay or government will give subsidy, depending upon how government wants to bring the change into the system. So I believe public transportation has to be green first to demonstrate that this is workable. Then automatically public buying of a vehicle or public getting into green through electric vehicle will happen. So one of the things which I believe government need to do is building infrastructure first. We need not wait the way the CNG was forced into the public transportation. Government has enough infrastructure. Every state government, if you look into everywhere, anywhere in the city or small town, government bus stops, government infrastructure is freely available for bringing in charging stations. If there are sufficient charging stations, the comfort of public in general also to join into the green revolution will happen. So I think the TCO will come automatically.
Yeah. Thanks. TCO will come automatically as scale and infrastructure develop. Okay. So I forgot to mention 2-3 minutes for the initial comments. Balaji, financing opportunity. What is the financing opportunity when you look at it from the side of money trying to make money?
See, I think it was best captured in the previous fireside chat when Mr. Rajneesh Kumar mentioned somebody has to pay. Customer is not bothered what is the source. The way I see it is as we as an economy grow, both at the overall level, at the individual household level, there will be increased requirement for goods and services which leads to increased financial requirements. It is an evolutionary approach. In the past few years, we have seen that corporates or institutions focusing on governance internally, better governance. Now going forward, apart from focusing on internal, they will also need to focus on external, paying attention how their products and services is going to impact the community and environment. To enable them to hasten the process of making funds available to where it is really required, two things are required. One, possibly an enabling infrastructure or regulation, what Umesh also spoke about. Like there should be a certain push which makes it easier for us to change. That is one. And two, credit or reward good or desired behavior. That could be in the form of incentives. We don't have to look at green as separate. If you go to 20 or 25 years back, Indian textiles were in dire state, and the government introduced TUF, Technology Upgradation Fund. Now, like that, if somebody is wanting to, green does not necessarily mean energy or transportation. It permeates to all sort of things, equipment, building materials, etc. How do we ensure that people who are financing such things, they do not lose commercially because they are answerable to the shareholders? How do they get certain mechanisms so that they can deliver a superior risk-adjusted return on equity to their shareholders?
Pakyo thought that. I'll come back to you, Balaji, on this. Tushar, your initial comments. Yeah.
Yeah, no, thank you. Thank you for having me here. The colleagues have already spoken about, I think, the commercial opportunity. So, the transitions in the framework overall leading to investments and, new goods and new services becoming available. Given my role sort of focusing on blended finance, maybe I'll touch upon the other side of it, which is how do framework builders or the people who are shaping that framework and the individuals which are really trying to sort of ensure that or try and find ways in which commercial entities adapt to it could sort of participate. And this is where the government, of course, plays a major role. But there is a role of concessional capital of other kinds here as well. Where especially when we think about adoption curves, and I know we'll speak about that more later, but when we speak about adoption curves, about knowledge building, around being able to find ways in which everyone, the organizations which are going to implement this transition, the financials get comfortable with it. I think there's a significant role for concessional capital providers like multilaterals, philanthropies, other developmental actors to play there. So that's an investment opportunity as well. It is a flow of capital which needs to happen over the next, I would say, 5 to 10 years so that we are able to do this quickly.
Thanks, Tushar. Yeah, making useful points here on saying need for concessional blending capital and therefore some public finance concessional role there. Labanya, your initial comments, yeah.
No, if we see the whole green transition, most of the businesses are capital intensive in nature. It could be renewable energy or industrial sector or clean transportation. When any business is in capital intensive in nature, so you will see that it's mostly financed by debt. So that's the thing we're talking about. In the next 5 or 10 years, as per the estimate by various agencies, maybe we need $600–700 billion. So out of that, if you assume that 70% of them capital is coming from debt financer, it means it's a massive opportunity for all kind of debt financiers. Since we are an economy which is a bank-driven economy instead of a corporate bond, we can see that corporate bond currently around 16% of GDP, but unfortunately corporate bond size is not increasing for the last 6–7 years or so. It means that it's an opportunities for banks and NBFC to provide capital. The question is that there is an opportunity, but is it bankable or not? Or can we enable these banks and NBFC? They have the balance sheet capital available in their balance sheet. Can they make it happen? Can they provide capital to the technology which is required, which require debt financing? We also spoke about the affordability of capital. On affordability of usage of capital, since cost of capital decides the user fees, it's important that debt financing plays a very, very critical role. So we'll speak more about that. How can we make the financing affordable?
No, yeah. No, thanks, Lavanya. Great points. Yeah, whether it's bankable, financeable, there is an opportunity. Okay, just to get to the rebound second round, I'm reminded of what my friend and colleague, senior colleague at CEEW, Gagan Sidhu, who is out there, I can't see him from here, he summarizes that very well in the term of green finance, that either capital is not there, or it is not flowing, or it is too expensive. On each of either it's not there, which also we think that from all kinds of models, it is not there because we are clearly talking of gaps. Gaps not there. You're talking of capital not flowing. Yeah, banking is not flowing. Bank to NBFC through not flowing. Markets not subscribing to green labeled bonds. Or it's far too expensive. For example, if you say this depends on the cost of money, here is a EV to be financed which comes at 13%, and you can finance a diesel car at 9%. So we are talking of cost, amount, and not flowing for a variety of reasons. To start with, I'll restart this round with Labanya. Now, is it a definition? Is it taxonomy? We have some definition. What more needs to be done for that? So that let's say Umesh and Shriram finance, and they are clear. He today probably, yeah, there is some understanding of what is green, but do we need further clarity? There's some work which has been going on for many years plus now. So yeah, definition, taxonomy, whichever way.
Taxonomy or definition will be critical, particularly in the financial sector, but I don't believe that it required for the real sector. The point is that there is an ambiguity in the financial sector when any financial product sold to any investors and say that, okay, ESG fund, for example, it's called green in nature, but there are enough evidence suggests that these financial products are not really green. So the point is that there are more than 50 countries actually have come out with a taxonomy. I don't believe that taxonomy has enabled these countries to propel the financing flows to green sector. Okay, so we cannot say that taxonomy is a panacea. It will help us definitely to differentiate between a green business and non-green business. And some of the businesses is very, very clear. For example, clean transportation or renewable energy is very, very clear. We don't need any taxonomy. But more importantly, we need to see that what kind of financial products we are selling in the financial market. There where taxonomy plays a very, very critical role. That's one. Number two is that we talk about standardization and interpretability. So there are several instances that several countries who have followed international standard, and they found out that just by following international standard, they missed the bus here. They are not able to mobilize capital from the domestic financial market because they are not able to understand what the taxonomy is. The third point is that about the easy implementation. So if we are going to follow European Union kind of taxonomy, which follow technical standard, it is very difficult for a commercial bank sitting somewhere in the tier 3 city to differentiate what exactly, whether this project is aligning with the taxonomy. Very, very difficult to do. Then fourth point is that taxonomy is not a standard thing. We need to keep additional money so that we can keep on developing that. So that will be very, very essential because there are several instances countries have not developed their taxonomies. I can see that in China in particular, they keep on developing this taxonomies which enable them to send a message to the market that it's not stagnant in nature. We keep on changing that. So it's important that we need to build capacity, we need to invest on data infrastructure so that the participant in the market can understand that, okay, whether these financial products or whether this project is different from non-green products. So that's very critical.
No, Labanya, I'm going to push you a little further because what I gather from my initial discussions here in this forum is financial Atmanirbharta. So because financial Atmanirbharta is what I'm understanding and what I'm calling is my domestic intermediation there is money not going to come from outside, whichever way. We are a large economy, we'll have to intermediate that now. My next question to you on the same subject. How important is taxonomy for domestic banking, to lend to green, for domestic capital markets to invest in green bonds, whether it can be municipal or otherwise? So what I'm saying is, in the context of saying international taxonomy, harmonization, leaving all that aside, financial Atmanirbharta, domestic intermediation, how important is taxonomy there?
Yeah, I believe that in the capital market, it's going to be very, very critical because we have a market capitalization of more than $4 trillion. So the question is that we are able to mobilize so much domestic capital who are investing in the stock market. And it is important that we can create financial product based on the taxonomy we are developing. It could be transition bonds, it could be, purely green ESG fund, for example, or green equity, for example, which can exclusively be used for green projects in the country. And we have also large institutional investors like pension fund, insurance companies, as well as the mutual funds. If I aggregate all the capitals they are currently managing, it will be close to $2 trillion, which is close to commercial banks. Can we use, mostly this kind of institutions, they invest money in government securities and also in stock market. Can we use that money, mobilize the money by developing appropriate financial product instead of just saying that, okay, this is green in nature, but in reality it's not green? Is it possible that to create such kind of products by aligning with the taxonomy? That's one. Second point is that about commercial banks and NBFCs, on certain sectors, certain businesses are purely green in nature. There is no ambiguity that we can say that, okay, whether nuclear is green or not, it's more of an international political in nature. But in our country, we know that, okay, these are the sectors which are called renewable energy. We may not need that taxonomy. But for example, in the case of transition loan, for example, here we are talking about providing capital for technologies which we are not sure that whether it is helping us in reducing carbon intensity of the business. There where taxonomy is going to play a critical role. Many times that we have seen that how greenwashing has punished the financial sector. So if we see that the greenwashing incidents over a long period of time, 25% of greenwashing issues coming from the financial sector. It means that by developing a better taxonomy, the financial sector can mobilize the capital without really exposed to greenwashing this. Because once you give a signal that we are not responsible, we are mis-selling the products, it means that you are going to miss the product, you miss the bus. For example, ESG fund, for last, after 2020, immediately we launched 5 to 6 ESG mutual fund in the country, and suddenly that nobody is launching any ESG mutual funds. I think that one of the reasons is that consumers are not convinced that companies are really investing in green products. Okay, there where taxonomy plays a role. I think SEBI has come out with some regulations which can help financial intermediaries to come out to design better products which are going to align with taxonomies.
No, great, thanks. There is a need to build that confidence and that assurance, and the need to be not subject to kind of greenwashing or perceptions of greenwashing. But coming to you, Tushar, is something which we have discussed a few times earlier. Is this issue of green credit versus price of credit, green, there is a perception, green, is it higher priced if I'm issuing a green bond? I get that from everywhere, rather almost, not really now, but till a few years ago, it was like I'm issuing a green bond, but it doesn't come at, even sovereign green bonds did not come at any greenium. So the concept of greenium, okay, just to be provocative, I think it's misplaced, your views over that, and how does this get corrected? Because whether it is for a consumer, it's you and I do not put money in a green fixed deposit, because the green fixed deposit, even with the RBI scheme, it pays you less than what a normal fixed deposit is. So where are we, how do you make this twain meet? Because we are in an anomaly over here. Your views, please. Yeah.
Yeah, no, I completely agree. And I mean, in part, when we speak about the green taxonomy, one of the things that we are focusing on is reducing transaction cost. And now that can provide a little bit of a bump up, facilitate some flow of capital, but is that enough? And therefore, more needs to potentially happen. And I'm just going to step up a little bit and maybe quickly highlight what are we really trying to solve here, right? I think these framework shifts have happened in the past. We've had new tech come up. We've had, adoption cycles. We've had cycles in which, there's been identification and recognition of which technology works, what kind of approaches work. Financials get comfortable with that, and then eventually finance flows. If we look at those kinds of cycles in the past as well, and therefore the question that I also often get asked when I talk about blended finance is that, why not just let it play out, right? I mean, it will eventually stabilize. Eventually, capital will flow. The challenge, of course, as all of us recognize, is that it's a question of time. Very often, these cycles can take a long period, can take decades. Therefore, what we are really trying to crunch here is that can we really accelerate that cycle of adoption? Can we really, get financiers to come on board quicker? Can we get adoption to happen faster? And that's where forcing or incentivization mechanism need to come into play. And that's where financing, and therefore, you spoke about cost, but I'll maybe add sort of a slightly broader element here as well. It's both about cost and risk, right? Because eventually both of them need to interplay with each other. And that's where financing tools could potentially play a role. In my mind, and then when we get to that sort of second order question of what sort of financial solutions could be the answer here, that is slightly more specific to the kind of context or technologies that we might speak about. If you're trying to solve for just risk perception, if you're trying to say that, look, there's, we heard Mr. Sinha earlier speak about technology which is ready to be implemented, which is commercially viable. However, is there confidence amongst financiers that this is something which will, this is the winner sort of in the pack, right? If that is the risk we are trying to cover, then instruments like guarantees, etc., potentially end up playing a role because we are helping mitigate risk. This might not lead to a reduction in cost. As we've seen very, very often, guarantees incentivize financiers to come participate in a sector, but that might not reduce cost. And then maybe I'll just add one more point and then pass it back to you, Dhruba. So therefore there are multiple tools there and there's lots which can be explored there, but often there is this element of how do you accelerate some of the knowledge curve. And then that's where sometimes the intervention is not directly financial, but is in the nature of capacity building and technical assistance. So we've spoken about the Green Bank, etc., and those kinds of platform initiatives are what very often can accelerate that curve, lead to greater adoption, more comfort, help everyone finance this faster, better, in larger quantums.
No, thanks. A very, very important point, Tushar. You make that guarantees, bring it into the financing fold, make it financeable, but does not necessarily reduce the cost of finance. Now here, that brings me to Balaji, you, of saying, if this were to be infrastructure, where you are in infrastructure, whether it's energy infrastructure, storage, transmission, pumped hydro, it can then go into hydrogen, storage, ammonia, green. You can just carry it on in terms of fuel cells and trucks and so on. So, coming back to this point which he made, Tushar, is cost is a function of information, not being there, technology, TRL, stages, also a function of duration, and also a function of who provides the risk assessment in the system, and what does the regulator believe in terms of allowing you to price or to provide capital to against it for capital adequacy. Now, if this becomes, if I were to ask you, all of this is infrastructure. How do you get to financing them at low cost infrastructure? Because without reducing the price of money, the green transition does not happen. Let's put it this way, because fuels, there are no fuels here, there are no operating costs here. So all that defines green transition or green economic transition or whatever you call it, net zero transition, is solely, or rather it will become too preposterous, but just 80% dependent on the cost of money. And every second person talks concessional, lower cost of money, and there you are sitting in the middle of saying, how do you reduce the cost of money? Go ahead.
I think basically we need to change our expectation. Instead of having the lowest cost of finance, what is the right cost of finance? Because resources, if misdirected, will lead to greater problems than the problems that they are attempting to solve. Here, the point what Tushar made is very relevant. Guarantees do not necessarily reduce the cost, but they enhance the flow because they reduce the perceived risk. And that was another point which you spoke about, right? How do you reduce the risk to increase the flow? Infrastructure is a very funny business because the impact it has, the execution is dependent not only on the project developer, it is also dependent on various authorities, right from the Supreme Court to the executive to the things. We all know what happened in the previous decade. Thousands of megawatts of power projects just became NPAs because of a single stroke of the pen. Now, how do we reduce such things? One thing is to have a clear regulatory framework for projects, not necessarily for financial sector overall. That's an evolutionary process that's happened. Two, a lot of things has got resolved since in 2015 when the Insolvency Act was enacted. A lot of things has got improved. But we need to instill the confidence because in infrastructure projects, well, the probability of default is high. If we take there is no siphoning of funds, the LGD is actually low. So therefore, how do we minimize the PD so that the lender more sources of financiers could fund it? That's one. One way to do it, there are mechanisms or interventions which the government and the regulators have done in other parts of the economy. Take, for example, MSMEs. Banks were reluctant to lend to MSMEs. So CGT MSE provides guarantees so that in case a loan becomes bad, you get your capital. Is there such a mechanism for infrastructure projects? That's one. Secondly, more importantly, the numbers are not large. So how do we create another mechanism? Take, for example, insurance companies. Insurance companies do not necessarily assume all the risks on the balance sheet. They give it to a reinsurer. Is there a refinancier for infrastructure projects? Because once if you do, then the infrastructure financiers would be able to approach it in a manner. But third and most importantly is to have a clear set of guidelines. Let's take RBI for example. NBFCs, you are supposed to have 15% capital adequacy, 10% tier 1. No funny or fancy accounting. Similarly, if you want to look at green financing, what constitutes green finance? A simple taxonomy. We do not look at what the West has developed. Take a simple mechanism which makes it clear for people to know whether what is it. Similarly, like what constitutes priority sector or agri-finance. So what constitutes green finance? Have a different risk weight asset. So these are the things which we should do. But primarily, more finance would approach this sector if the risk is reduced, and that's where Tushar and his hill can help through providing concessional capital or blended finance so as to ensure that we transition faster on this journey.
Thanks, Balaji. I'm tempted and I will push you a little further. I'll push you a little further here on this. Yeah, you mentioned reduce risk weights for green. Maybe it's useful to talk to the regulator on that, but that's just parking that point here. But coming back to what you said, you know, you were intuitively saying the PD for infrastructure projects is high. That was there in your mind. It's an intuitive thinking that you have as a financiers have. And I can tell you that much, that I'll produce you data on infrastructure projects actually going by the default rates over the last 10 years. And the PD as given by the rating agencies is high. But when you reconfirm with the data of default, which is cumulative default rate, the PD projected by the rating agencies, which is there in your mind, does not match the data.
I said LGD is low actually. See, that's the thing. See,
LGD is equally low.
We need to understand psyche of, sorry.
So here's the perception. So I think there is a perception of risk that needs to be beaten. That's the point. But please respond. Yeah, go ahead.
Yeah, see, everybody knows for a fact, any entrepreneur, they bring in their capital for their first project. After that, they don't bring in any more capital. And now, if you're in a largely capital-intensive business, how do you fund it? It's not possible for you to be in a capital-intensive business and if you don't want to let go of control. And that's an issue. So the thing that everybody, financial institutions, etc., should happen is we should start looking at diversifying the sources of liabilities. CDS assumed a very bad word after the financial crisis, but they went overboard, getting into synthetic CDSs and etc. But if we can focus on that, and to have an enabling regulatory framework provided by support from institutions which are there. Because what we are trying to do is possibly patently unfair. A financial institution, whether a bank or an NBFC, is there to generate economic returns. Now the government and other parts of the society are pushing it to deliver societal returns, which is not in its mandate.
Exactly. Very good, very well said. Thank you so much. We are not merging, converging on societal and shareholder returns. Maybe we need to change over here. Very, very valid points, and thanks for your points on insisting on sanctity of contracts, rule of law, consistency of policy, which is what was coming about when we were talking to the finance secretary today morning, saying, here is the lack of pipeline. The lack of pipeline, lack of bankability comes from there. Thank you so much. Coming to you, Umesh, maybe I'll have some time for the audience questions. But assuming in your business, which you do a wide range of, I think I would say, NBFC operations, starting from auto loans to business loans to SME to gold loans, you have a, now, how do you see yourself, or, I mean, you represent the industry, or represent the industry here, how does this industry, which constitutes a large chunk of what gets intermediated, first round of financing for anyone, any project, any business, how does this get to shift itself to green? How does this shift itself to doing more of green economy? Businesses can too be green.
Let me start with
Sure.
ESG,
Anything else that you want to cover?
ESG funds.
Sure. Yeah.
We have been accessing ESG funds internationally for last seven years now. When we went for ECB bonds, we were advised by international bankers that there is separate allocation for ESG funds, and you will definitely get cheaper access to ESG funds. So we converted our bonds, even though ESG also has environment, we converted into social bonds because we are not directly meeting the environmental part, but the environment and sustainable income part of it we were meeting. And we did not really see a difference between the rates over the 7 years. And it's not, you can't expect it, because why should investor invest without having any advantage of it? He doesn't get anything unless government gives some tax breaks, which current dispensation of income tax, if you see, they don't want to give any tax breaks. So there's a change in direction. So you were expecting to invest into green bond and expecting a tax break is little too much to expect, I believe. So why should somebody? So the sources of funds for us is common. So I don't think you will get, even if, of course, there are some international agencies, DFIs today, including ADB, DFI, many of the European DFIs, they are saying, you make it pure green, we will give you subsidized rates. But okay, that is something we are trying to build green portfolio so that we'll see whether we'll get it or not. That is subjective, but we are mixing it now. So we are increasing green financing so that it becomes acceptable over the period, and hoping that it will bring down the cost. So for us, what we are trying to do is we are trying to see how much green only vehicles we are financing. We are also looking at rooftop solar panels. We are also looking at battery charging stations as a commercially viable battery charging stations for financing and building certain. Not only Shriram, there are other NBFC industry also are looking into it. But for us, the viability for this will come only a commercial viability. There is nothing called, because government can do two things. Like in affordable housing, they gave interest subsidy. They can give interest subsidy directly to the customer. That's one thing. Second, all the governments can do tax, like electric vehicles. Some of the state, they have waived off the registration fee or the what to call, and you can make toll free for the green. See, these are all the things which directly impact. So you have a capital cost coming down because your registration cost coming down, your running cost coming down because toll is free, that will induce the customer to get into, because ultimately it's the TCO, cost of operation. So this is something which government can do directly by handing over to the customer rather than through financial instruments. That will benefit the customer directly.
Thank you, Umesh. I may be able to take a couple of questions, but what I'm arriving at is very clearly finance, green, finance has to make money, adequately risk-priced commercial returns. It is a social outcome, not a private outcome that is being desired. Therefore, there needs to be a subsidy to capital or directly to the consumer, and the depositor who is actually seeking returns is not going to compromise. So we have a case in point for maybe even a tax subsidy or a tax waiver, which used to be there, by the way, for infrastructure. Okay, thank you all so much, but if there are any pressing questions I can see a hand up, I can take probably 2 questions, maybe direct your question open or to any specific panelist. Thank you. Please introduce yourself. Can somebody please hand over a microphone to?
Thank you. I'm Rohan Gala. I represent Spectrum Impact, which is a family office, and we've also done some lending. A couple of observations here. So, first of a kind of anything is a challenge when it comes down to financing. We experience this ourselves when three-wheeler, commercial vehicle financing was not picking up in the country because half the price of the vehicle is just a battery, which financiers were not willing to. Every financier wanted to see, can I underwrite this? What is the data? And everybody wants to see data before they can actually go and underwrite this. We kind of played some role in doing this, and then the ecosystem picked up. So I think the question about lowering the cost of capital is one thing, but if you have enough capital going in towards that opportunity, the cost will automatically come to something that's logical given the competition in the ecosystem. So I think the problem is really getting the first of a kind financed. So there I have a question, we have the electric vehicles, battery, etc. But there's a lot of stuff that needs to happen on the industrial side, where there are new technologies, new instruments that need to be put up, bigger capital costs, etc. And there is a huge risk of a technology failing. So industry is not willing to take that up, and financing doesn't happen. Is there a way to sort of bridge this and do first of a kind financing?
Anybody, if it's not specifically Tushar, would you take a shot at it?
Yeah, no, very happy to, and thank you, Rohan. I think that's a great point. To almost classify it as first of a kind financing. What you're fundamentally getting to, if I'm reading between the lines, is to say that there is always a higher risk perception when it is happening for the first time, because data is one part of it, but also the person evaluating the loan, they've not done this before, new things come up, unknowns come up, you don't know what happens 15 years down the line, do you have a view on the tech cycle, etc. Those kinds of things come up. So I think going back to what Dhruba also mentioned before, and what I'd mentioned as part of my earlier comments, I feel like therefore the ability to mitigate risk rather than necessarily focus on cost and incentivize or find ways in which financiers are willing to say, okay, we'll direct capital here, right? And you'll always have early adopters, and there are always early adopters who might be trying to break into a particular industry or who might be, might want to do this for other reasons. Those can then become the basis for the data and go forward. So therefore, I feel like the role here, whether it's the government or it is other concessional capital providers, here is really to find ways in which you can reduce risk, which could also be a data ecosystem creation exercise, but sometimes that doesn't exist. So then you have measures such as guarantees, etc., which come in. So I feel like it's a great point, and I think it really emphasizes the need for focusing on the other side of cost, which is the risk aspect of it.
Thank you, Tushar. I think time's up. All of them are available, so maybe we can take rest of the questions offline after the session. Thank you all so much for this interesting discussion. Thank you.
Thank you, Dhruba, for steering this conversation. Just hold on for a customary photograph. And may I request Richa Malik to come forward. Richa, help us in paying the gratitude to the gentleman here. And Richa is also adding gender diversity to the group. Dhruba, thank you very much. Ladies and gentlemen, Mr. R. Balaji, Labanya, Prakash, Jena, Tushar, Thakkar, Umesh, Revankar. Thank you, Richa. Thank you very much. So I'm also taking the opportunity to give gratitudes to Climate Policy Initiative, CEEW, Climate Bonds. They are the knowledge partners along with Dalberg's team for this, curating this credit summit. Along with them, we partnered with the Shamlav Advisors, PTC Financials, Chola Mandalam, along with DMI Finance. We are grateful to all of them for supporting this credit summit. So let's move from the opportunities to risk, the deep dive into how climate risks, both physical as well as transitional, are impacting the lending portfolios and what financial institutions